Other retirement accounts, including simple plans, for the self-employed. Employer plans that are qualified by the self-employed are labeled as defined contribution or defined benefit plans by the IRS. In order to set up a defined contribution or defined benefit plan, the employer must either adopt a plan or prototype that has been approved by the IRS from a sponsoring organization or formulate and enforce a written plan that fulfills the eligibility requirements of the Internal Revenue Code. Types of qualified retirement plans. A defined contribution plan gives each participant an individual account. The amount contributed to a participant's account is the main factor in providing benefits. Any income, expenses, gains, losses, and forfeitures of other accounts that may be assigned to an account are also reflected in benefits. Defined contribution plans have a variety of options, including: Number 1. The objective of a profit-sharing plan is to allocate company profits to the employees of the company. Employers do not have to contribute out of net profits in a profit-sharing plan. Number 2. Money purchase pension plan contributions are unaffected by the company's profits. Despite the fact that self-employed individuals are compensated based on earned income derived from business profits, this still holds true. Number 3. An ESOP is a plan for employees that is tax qualified and gives them shares of stock in the sponsoring company. The annual contributions made by a defined contribution plan to a participant's account in 2024 cannot go beyond $69,000 or 100% of the compensation paid to the participant. The amount needed to fulfill the requirements established by the employer is the basis for calculation of contributions to a defined benefit plan. For 2024, the annual benefit for a participant under a defined benefit plan cannot be more than the lesser of $275,000 or 100% of the participant's average compensation for his or her highest 3 consecutive calendar years. In general, contributions to both types of plans, including those made for a self-employed individual's own benefit, can be deducted, provided that certain limits are met. Self-employed only individuals who have net earnings from self-employment can make contributions on their own behalf. Compensation is the payment a participant receives from their employer for personal services over the course of 1 year. The package comprises wages and salaries, fees, commissions, tips, fringe benefits, and bonuses. It excludes reimbursement or other allowances for expenses. Compensation is the payment a participant receives from their employer for personal services over the course of 1 year. The package comprises wages and salaries, fees, commissions, tips, fringe benefits, and bonuses. It excludes reimbursement or other allowances for expenses. Number 3. The primary investment requirement for an ESOP is employer stock, and it is permitted to borrow money on a tax-deductible basis to purchase this stock. Number 4. An actuary is responsible for calculating the deduction for contributions to a defined benefit plan, which is based on actuarial assumptions. Excess contribution. In case an employer contributes more than can be deducted in the current year, the extra money can be carried forward and deducted in future years. Elective deferrals for 401k plans. A qualified plan can include a cash or deferred arrangement, under which eligible employees can elect to have part of their before-tax pay contributed to the plan rather than receive the pay in cash. Until it is distributed, this contribution is tax-free and referred to as an elective deferral. A defined benefit plan with a salary reduction arrangement is an option for setting up a 401k. Nonprofit organizations and certain governments have a retirement plan called a 403b plan. Under a qualified 401k plan, employers can make contributions, other than matching contributions, for participating employees without allowing them to choose to take cash. Rollovers of simple IRAs. Rolling over an eligible rollover distribution from these qualified plans into an IRA or other eligible retirement plan can allow the tax to be deferred. Withholding tax may be charged for rollovers. If a rollover distribution is eligible and expected to total more than $200, the payer must deduct 20% from each distribution for federal income tax. Hence, direct rollovers that do not withhold taxes should always be utilized. Thank you and God bless you.